what we have in front of us is what you want, a positive skew over a longer duration of a greater and a positive return, but short term might cause panic. Now, you could create a trading strategy if you wanted. We're not here to trade, we're here to invest. What that basically is telling you on the screen is do not panic, do not get bored. But there are very few companies like that. That's why we have to look through 10,000. And can that take you from a 7% annual return to 15 to 40? Well, last 2 years, the market has been doing so bloody well that, yeah, you get a tailwind, you make ridiculous sums. Will that continue? I have no guarantee at all. The market might never rise ever again after tonight. Who knows? Now, Alphabet, very similar. Look, similar kind of story. But if you are not prepared for this, and you're going to try and trade it, you're more likely to get wrong-footed. That's Alphabet's return distribution. So I know not to panic if after 20 days it's down 18%. In fact, guess what? I know what to do. Yup, you guessed it. Put it in the comments box to buy it. And my God, if it's down after 50 days, 28%, I am doing a rain dance. Why? Because I'm knowing if something's down 28%, that means it's going to rise to get back to where it was, 35%. If that's going to go up 35%, I've just locked in a 35% rise in my pension. Thank you. Please fall. Please fall 28%. Because guess what? When it falls 28%, goes back to where it was, I make back anything that I might have lost on paper, plus I get to buy in and make the extra gain as well. And when I do that on double leverage, even easier. But forget leverage for a second. Those kind of return histograms, there's under 10 companies out of 10,000. I wish I could invent them. If I could, I would. Right? So I'm more than happy with those. Okay. NVIDIA. Let's look at this because it's popular. That's 2022. Now, in 2022, we had to hold cash because virtually every single stock was looking like this. Okay, it looked like, I wasn't guaranteed, a prolonged fall. In fact, it looked like it earlier this year. And I ended up exiting NVIDIA at the daddy bear stage only to buy back more expensive later. So I ended up exiting around there-ish and having to buy back a bit more expensive. It was an insurance policy I had to pay. So be it. But it avoided me having this period and the uncertainty that I might be locked in to that kind of a fall. You might say, well, in hindsight, it was obvious it was always going to rise. Well done you. You're better the person than I am. Easily done. Others would say, no. I'm always going to just keep doubling down. So what I'm saying is there's alternative approaches based upon your own appetite. You don't have to stick to one type of view. Got it? By the way, as we go into this, I'm also on LinkedIn.